Could gold, a metal that has captivated humanity for millennia, truly reach a price of $4,700 an ounce? A metal that has captivated humanity for millennia. This is a question being asked in serious financial circles as we navigate the complexities of early 2026. It is not a question born of pure speculation, but rather one rooted in a growing sense of unease that permeates the global economic landscape. The persistent specter of trade wars, with their potential to disrupt supply chains and stifle international growth, has become a primary driver of investor anxiety. When the foundations of global trade appear to be shifting, the fear of a sudden and sharp downturn in equity markets becomes palpable, prompting a fundamental reevaluation of risk across all asset classes. In this climate of heightened uncertainty, a timeless search begins anew: the search for safety. Investors, from large institutional funds managing billions of dollars to individuals planning for retirement, start to look for assets that can weather the storm. So, what exactly do we mean when we use the term safe haven? At its core, a safe haven asset is an investment expected to retain or even increase in value during market turbulence and economic distress. It's a financial port in a storm. While no asset is entirely without risk, a safe haven tends to have low or negative correlation with the broader market. When riskier assets like stocks fall sharply, a safe haven often holds its ground or even appreciates as capital flows out of risk and into perceived safety. Gold has long been seen as the quintessential safe haven asset for reasons rooted in history and human psychology. Unlike currencies that can be printed and devalued, gold's supply is finite and grows slowly through mining. It carries no credit risk. Its value doesn't depend on a government's or corporation's promise to pay. For centuries, it's been a universal symbol of wealth and a store of value that crosses borders and regimes, acting as an anchor when faith in other instruments wavers. The movement of large-scale institutional capital, the so-called smart money, is often a leading indicator of broad market trends. In recent months, we have observed a clear, deliberate rotation of funds into precious metals. There are three primary, interconnected reasons driving this shift. First, escalating global trade tension. The prospect of a full-blown trade war introduces deep uncertainty. Such conflicts can lead to slower global growth. They can disrupt corporate earnings. They can trigger sharp sell-offs in stock markets. In that environment, gold's lack of correlation to the business cycle is a major strength. It attracts capital fleeing anticipated equity volatility. Second, the likely response from central banks to slowdown. Faced with faltering growth, central banks like the US Fed tend toward more accommodative policy. That often means cutting interest rates. When rates fall, returns from government bonds and fixed income diminish. That changes the investment calculus for gold. Gold pays no yield. Its drawback in a high-rate world is opportunity cost. As rates approach zero, that opportunity cost evaporates. Gold becomes comparatively more attractive. Third, fear of currency debasement and long-term inflation. Stimulus and quantitative easing can expand money supply and erode purchasing power. So institutions buy gold as crash hedge and long-term insurance against devaluation. These forces are visible in rising gold ETF inflows and disclosures of larger precious metals positions, a calculated, data-driven defense, not panic. To fully grasp the dynamics of the gold market, one must understand its intricate and often inverse relationship with the US dollar. As a general rule, when the value of the US dollar rises, the price of gold tends to fall. Conversely, when the US dollar weakens, the price of gold tends to rise. This inverse dance is driven by two straightforward mechanics that every investor should know. Mechanic 1. Gold's global benchmark price is quoted in US dollars. If the dollar strengthens, it takes fewer dollars to buy an ounce, pushing the dollar price of gold down. Stronger dollar makes gold costlier in foreign currencies, damping demand. Example: Euro. Example: Japanese yen. A weaker dollar requires more dollars per ounce, lifting gold's dollar price. That higher dollar price can make gold cheaper abroad, boosting demand. Mechanic 2. The dollar and gold often compete as primary safe haven assets. In global uncertainty, capital flows into treasuries, requiring foreign investors to buy dollars, strengthening the dollar. But if weakness is US-centric, rising debt or aggressive rate cuts can erode faith in the dollar, and capital can rotate into gold. One of the most compelling visual arguments for gold's role as a portfolio hedge comes from simply comparing its price performance against that of the broader stock market, often represented by the S&P 500 index. The S&P 500 tracks 500 of the largest U.S. companies. It's a barometer for corporate health and sentiment. In expansions, the index tends to trend upward. In crises, it can fall dramatically, erasing wealth quickly. It is during these declines that gold shows its value. Historical charts frequently reveal a clear divergence. The S&P 500 line plunges downward, while the gold price line often moves the opposite direction, climbing upward. This is the safe haven rotation in real time. As investors sell to lock gains or cut losses, a portion seeks refuge in gold, lifting its price. The negative correlation isn't perfect, but it's consistent enough to shape modern portfolios. That divergence provides powerful financial stabilization. Recognizing the need for a hedge is the first step. Implementing it effectively is the next. Adding precious metals need not be complex. Several straightforward methods, each with pros and cons. Direct ownership, physical gold or silver coins and bars. Ultimate control, but requires secure storage and insurance. Consider safe deposit boxes, home safes, and coverage. Gold-backed ETFs trade like stocks, closely tracking spot. Easy to buy and sell via brokerage, with small annual fees. Mining equities can offer leveraged exposure. Higher potential returns, but with operational, geopolitical, and management risks. Miners can fall even when gold rises. Futures and options suit advanced traders. Most should stick to bullion or ETFs. Common guidance, 5 to 10% allocation to precious metals. Enough to hedge downturns without overly dragging bull market returns. The 4,700 conversation, trade wars, and volatility all point to one principle: diversification. This is not merely a buzzword. Don't put all your eggs in one basket. Institutions are rebalancing, using gold and silver to build resilience across cycles. Think of metals as an insurance premium. Maintain a long-term view, set targets, rebalance, and avoid all or nothing moves. In an uncertain world, prudence is your greatest asset.